Good to see you. Ed Ponsi here, your FX educator, here on behalf of FX Street once again. Let's take a look around and see what's happening out there. Happy Monday, everybody. June 26th, the first of two sessions today. As we wrap up June, and we're coming to the end of the first half. Almost said the first quarter. It's actually coming to the end of the first half of the year, second quarter of the year. British pound making a little bit of a bullish move today, right? Creeping back up toward the area where we want to sell. And that's because of agreements apparently between Theresa May and her Conservative Party and the DUP party on a coalition. So some sort of agreement perhaps being reached or rumored to being reached, and that apparently the pound got a little bit of a lift out of that. I'm going to go to the 5-minute. It's still not quite to the area where we want to sell yet, so I'm not getting too excited just yet, but it's creeping up into that area. But you might notice it's not really. Now, we don't exactly have a giant green candle on the daily chart, so it's not exactly flying up there. But we did get, you can see here, we got a little bit of a boost here. We jumped from about 127 to about 127.40. So it got a little bit of life on that news. And we did come up from, we're about 100 pips above where we were on Friday at this time. So, it's a little bit bullish. But still not to where I would like to sell. Dollar yen is on the move, and that's also something I'd like to short. Again, toward 112.50 is the area I'm looking for. We're getting there. We're at about 111.65 right now. This is an interesting pattern. This is a bull flag. And according to this bull flag, we should get to this to our sell point. Right? If you look at this. This is bullish, actually. And you could buy based on this. I'm looking at the overall downtrend, right? Longer term, it's in a downtrend, but shorter term, it's in an uptrend. So it really depends on your time frame. If I focus in on this is an uptrend. This is bullish, right? If I focus outward, it's on a downtrend and it's bearish, right? So in the very short term, if you're trying to make money, over the next 24 hours, I'd probably be a bull here and be a buyer. Right, so let's push this back to a 240. Well, actually, we can leave it on this time frame. The way this works, this is your bull flag. Here, you have a bullish move. The big green candle says the bulls are in charge. The little red candles tell us that the bears really have no reply. They have nothing to say here. And then big green candle totally wipes out 4 little red candles. Just totally negates it. Okay? And so what you had here is 4 days worth of bearish activity just wiped out. So these bears have to cover. And that should help to push this higher. So, it's debatable. I mean, it could be high 112s, it could be 113s. Carlos says 113s. I mean, it depends. I mean, I'm looking at the trend line here. The trend line's coming down. You could look at this area and say that's resistance. That's 114. So there's a lot of different ways you could look at this. But let's put it this way. If you want to short it, and if you want to short this overall longer-term downtrend, you probably want this to come a little bit higher. And you probably have a longer-term outlook, like, somebody who trades daily charts or weekly charts. If you trade shorter-term charts, intraday charts, you're probably looking at this as a bull. I'm going to look at this on shorter term here. 240 minute, for example. Whoops. Let's try for the 240 minute. That's a 4-hour chart. It's another way of saying 4-hour chart is 240 minute, which is a time frame that, certainly stock traders don't use it. In the US, our stock market is only open 6.5 hours a day, so a 4-hour chart is really wouldn't make a lot of sense, right, to use that. Let's wait around here. Come on, TradeStation. How many seconds are in 240 hours? 240 minutes. Let's see. 240 times 60. There we go. So yeah, I don't know if that clarifies the situation at all, but this is kind of a consolidation and breakout type situation. And it's not really broken out, right? This is the high of the pattern, and this is where we are now. So it really should go a little bit higher. It really needs to go a little bit higher before it can truly break out. But anyway, futures, S&P futures are probably helping this, and stocks are helping. Stocks have been moving higher, and that's probably helpful to this chart. If I'm going to go at ES here, there's S&P futures, right? And you can see they've been creeping higher. Remember this? Remember it looked like a top? But it didn't. It just kept going higher. I can't tell you how many times that's happened, right? Where it appeared that it wanted to go lower, but it just didn't. And that's happened so many times on the way up, It's just lighter than air, it just wants to keep floating higher. And here we are again, another green candle on the S&P futures. It just wants to go higher. So that really helps the yen pairs to move higher too, including dollar yen. So we could be looking at another green day here on the S&P futures. And the rally continues. What can I say? I mean, look at this. Here's the election right here. You've got the big wick down. And ever since the election, I mean, can you consider all the ups and downs? But really, despite all the ups and downs, you can draw one very smooth trend line beneath it all, and one very smooth parallel line above it all. Maybe not so smooth above it all, but it's pretty clear that you're in a bull channel here ever since the election. And all-time highs, and really even since before the election. So I'm not saying this is necessarily based on the election. This has been going on for a long time. Now, part of this has to do with interest rates as well, and this plays to dollar yen as well. Dollar yen should be influenced by interest rates rising in the U.S., should make dollar yen go higher. You look at the differential between U.S. bonds and Japanese bonds. Japanese interest rates are going to stay at zero. They're not going to go up, maybe never. I mean, not in our lifetimes, very possibly. Whereas U.S. rates are certainly moving higher. I don't know if they'll continue to move higher. I don't know if it makes sense for them to continue to move higher. But the Fed seems determined to keep going up, at least once or twice more this year. I don't know if you can really see any farther beyond that. We have a ton of Fed speakers today. And will they shed any light on this? They're not listed here. That's probably a good thing. I mean, who needs to hear all this? We do have Draghi later on today, but there must be like at least 5 different Fed speakers today. And they just can't seem to stop talking about policy. And but the real thing that drives this is capital flows. The thing that drives Forex is money flows. If there are higher interest rates, substantially higher rates in one country over another, you're going to see that currency pair move. Or if there's a substantial change in interest rates in one country against another, you're going to see that currency pair move. And to me, dollar yen, despite the fact that rates have moved in the U.S., the Fed has moved rates, the 10-year bond is at 2.14. This is the interest rate that matters. This is not the interest rate. This is the bond price. It's moving up. When the bond price is moving up, the interest rate is moving down. You could look at this chart and say that U.S. interest rates are falling, not rising. They're falling. That's why in the longer term, even though in the short term, dollar yen is rising, in the longer term, shorting it seems to make sense based on this chart. Okay? This is the price, not the yield. If you want the yield, you have to look at this chart upside down. Not kidding. The yield is the exact inverse of this chart. Okay? Price goes up, yield goes down, just like a stock, right? If AT&T stock price goes up, the more you pay for it, the less the dividend actually yields. It doesn't change the dividend, but you're paying more for the dividend, which means you get less out of it. If AT&T stock falls, you pay less for the dividend, which means the yield is more to you. Same is true with a bond. Pay more for the bond, the yield is less to you. This is the price of the bond going up, right? So if the price of the bond is going up, the yield is going down, that's bad news for dollar yen. Dollar yen could fall. That's another reason why I like this as a short, not just the technical chart. To me, the fundamentals, not all the fundamentals, but if you look at the fundamentals as far as based on interest rate differentials, it makes sense. Okay, that play makes sense. So even on the very, very short term, technically a long makes sense, but I could see how that is not going to last. And but shorting this makes a lot more sense because look at the way the bond market is behaving. That's where I'm taking my cues on this one. Okay? All right, let's move on. The euro. Anything happening here, gang? This thing made this rounded top, but it never followed through. I'm not surprised. The euro has just been super frustrating. Not only that, but it's extremely low volatility. We looked at it last week. It was moving 63 pips per day based on ATR. I'm just going to nuke this ARC. I don't even know if I trust it. Let's give it a little more time to form here. See what creates out of this. Maybe it'll form a head and shoulders or something. I don't know. But I don't trust it right now. And it's just drifting sideways. Very frustrating. The ATR, very frustrating if you're trying to trade it short-term or long-term because it won't move. Now it's moving 61 pips per day. So it's like watching paint dry. If you're going to trade short-term, I'd much rather trade something with a pound in it. Pound has a lot more activity. This is a flag. I'm sorry, a pennant. on euro pound. And this would seem to say that it's going higher. Look at that. Same idea as the flag, but it's a different type of formation. There's your flag pole, and there's your pennant, which is just a consolidation. In theory, the price should move the same distance as the flagpole. So you measure the flagpole, 86.50. This is 86.50 here. And it goes all the way up to 88.50. That's 200 pips, right? So from the breakout point, which is going to be about, if it breaks out, now there's no guarantee that it'll break out. Okay, it might never break out, but if it does, that breakout point is going to be approximately 88.00. So if it breaks out, the target would be the same distance as the flagpole. The flagpole is 200. So the target would be 88 plus 200 is 90. So the target is euro pound 90, which is right here. And it's kind of interesting because there is some resistance up here. Just beyond that, looks like maybe 20 pips higher, 20, 25 pips above, you've got resistance. So that's kind of interesting. This might be worth a play. But how to play it? Well, there's no trade unless there's a breakout, correct? So you need the price above 88 for the breakout. So let's say all right, let's say, trying to think here. Okay, let's do the math here. So we've got about a 200 pip area to play around in, correct? 10% of 200 would be 20. Fair enough? So everything is going to run off of that 20 pip figure. The entry will be 88.20. Why? Because this way the price has to break out or there will be no entry. Make sense? If there's no breakout, if there's no breakout, there will be no entry. Right? If this thing just comes out and spills out of this pattern and drops, there's no entry, you cancel the trade. It has to come up out of that pattern. Again, 10% of 200 is 20. The breakout point is 88.00. 20 below that figure is 87.80, and that's going to be our stop. So I've got 88.20 for an entry. I've got 87.80 for a stop. This is not a trade recommendation. In case you're wondering, this is just simply me laying out how someone might trade this pattern. Okay, so I've got 40 pips worth of risk. We said our target is all the way up at 90. Now, I consider that the upper range. Now, just keep in mind, when people came up with the entire concept of using measuring techniques, the entire concept of using measuring techniques to create targets was invented before people had personal computers and before people had their own charts. So, you know, using measuring techniques is very primitive. So I'm not simply going to use 90 or 0.9000 as a target. To me, that's the upper bound. But I always feel like if you're shooting for the very upper end of the range, I always felt like that was being a little bit greedy. I don't need to make every last pip out of this trade. Instead, I'm going to go under 90. How far? How about 10% of that 200 pip range? I'll go 20 pips beneath 90, which is 89.80. And that'll be my target. Because if anyone out there is using the measuring technique, they're probably shooting for 90. So there might be a lot of sell orders at 90. I'll be getting out before those folks. They're getting out at 90. I'm getting out 20 pips earlier at 89.80. So let them all fight each other to get out. I'll be gone. I'm reading here that 1.8 million ounces of gold traded in 1 minute just came across the Bloomberg screen. So we'll take a look at that later. So just from here, what's the risk reward here? The risk is 40, the reward is 160. Excuse me. So that would seem to be a 4-to-1 reward to risk on this trade.